Hello, welcome back. This is Wendy McCroskey, a real estate agent with Keller Williams, and we're here again with Marcy Briggs with Nova Home Loans. She has so graciously donated her time today to educate us, and I want to talk to you a little bit about FHA and conventional loans.
Okay.
As we know, or we might know, that FHA and conventional loans have changed a lot, whereas
Absolutely.
used to everyone kind of pushed towards conventional, and now in the Phoenix market, FHA is definitely very popular. What do you think is a good idea for buyers to kind of, what's maybe the difference of an FHA versus conventional, or why someone would want to use one or the other?
Good question. There are a lot of differences, but I want to start with dispelling some of the myths that people think about FHA.
Okay.
Back in the heyday, the 2005 to 2006, everyone wanted an 80-20 loan, meaning they had an 80% first, a 20% second, because they didn't want mortgage insurance, because mortgage insurance was perceived as a bad thing.
Right.
People have really changed their thought process on that, and FHA has been around for a long time, and it's here for a reason. And I want to dispel a couple of those myths right here. Number one, people think FHA is only for first-time home buyers, and it's absolutely not.
Right.
What I think that gets confused with is it has to be a primary residence. So you have to live in the house, but it doesn't have to be the first home
Right.
that you've ever bought. Second myth is that it's for people with bad credit. Absolutely not true. Again, people with 800 credit scores are using FHA financing in today's market. And the third thing is that people who don't have a lot of money utilize FHA, and that's not correct either.
Right.
We have people putting 20% down payments on an FHA loan, and in some cases it does make sense for them. So it's not a one-size-fits-all if someone should go FHA or should go conventional, but here's some of the differences. FHA, like I said, has to be a primary residence, whereas conventional, it can be a primary residence, it can be a second home, or it can be an investment property.
Right.
With FHA, the credit score requirements are going to be a lot more lenient than with conventional. With FHA, you're going to be able typically to go down to about a 600 credit score. Now, that doesn't necessarily mean you qualify just if you have the credit score. There are other parameters, but you're not going to be able to get conventional financing with a 600 credit score. With conventional, the interest rates right now are slightly higher than FHA, which people are typically of the impression that FHA would be higher. That's
Right.
not correct. Now, with FHA, you will always have an upfront mortgage insurance premium that's financed into the loan, whereas conventional, you don't have that. With FHA, you will always have a monthly mortgage insurance premium, whereas with conventional, it's only if you have less than 20% down.
Right.
Conventional allows for the minimum you can put down with conventional is 3%, whereas FHA is 3.5%. They both have similar terms in terms of you could do a 30-year, you could do a 15-year, you could do an adjustable rate mortgage with both of them. They're both great loan products depending on what someone's looking for. For example, here, Arizona, right, ASU, go ASU, we get a lot of college kids, right? So a lot of parents, maybe from out of state, maybe not from out of state, want to buy something so that they don't have to pay rent or live in the dorms.
Right.
With FHA, they call it a kitty condo. It doesn't have to be a condo. That's another misconception. It can be a single-family home. But Joe, college student, is the home buyer. He may or may not have a job.
Right.
And mom and dad are the co-borrowers. Joe, college student, is going to live in the house. Mom and dad are basically co-signing for him or her, but it's considered a primary residence because he's going to live in it. Now, with conventional, there are ways to get it done, but it's not as easy. It's a lot more difficult. So FHA is a lot more co-signer friendly, if you will. FHA right now, the hot topic, foreclosures and short sales, right? FHA is going to not require as much time after a foreclosure or short sale as conventional. FHA is not going to require as much time after a bankruptcy as conventional. So FHA, one other thing that people don't think about, they bought their house in 2005, right, with the 80-20, because that's what everybody wanted. Yay! Well, now they go to refinance, they can't because they're upside down.
Right.
If they were in FHA financing, even though they would have had the mortgage insurance, they could now do a streamlined FHA refinance without an appraisal required and drop their interest rate. So paying that mortgage insurance would have made sense because it would have protected them, in essence, from being able to refinance in the future.
Right.
So there are a lot of misconceptions about FHA. FHA has kind of been given a bad name. It's like it's a 4-letter word, only it's only 3 letters. And it's not. FHA, hands down, 2010, about 73% of my business was FHA.
Right. And it is different. Like, I know when I've been in real estate for 13 years, initially FHA was very challenging, and even the listing agents, you'd write an FHA
Oh,
offer and they
yeah.
were like, no way, we're not taking that. We
Right.
want conventional buyers. And it's totally changed.
Totally
So
different.
if you were in that market before and you kind of saw that FHA negative stigma that comes with it,
Right.
it's definitely not the same. I would say the majority of our deals now are FHA for
Absolutely.
primary residence. Now you mentioned as low as 3% down on a conventional loan. Are you really seeing that down payment, or is most people on a conventional going 20% down?
You know, good question. Most of the time, if we compare an FHA 3.5% down loan to a conventional 3% down loan, it makes more sense to go FHA.
Okay.
Because the monthly mortgage insurance on a 3% down conventional is going to be higher. So while they don't have that upfront mortgage insurance, we basically weigh out the options back and forth. A majority of conventional buyers, to answer your question, are putting 20% down. Otherwise, they're going FHA, and we look at all options for them. It can depend on the home buyer, but yes, we are still seeing a lot of 20% down. That kind of leads me into there's kind of a myth going on. I know you probably run into this. Someone asks you what you do for a living, you tell them, and they look like your dog just died, and they apologize to you.
Real estate. Oh.
Yeah,
How's that going?
Yeah. I get I heard banks aren't lending any money. Well, I can tell you 2010 was the best year that I've ever had in 14 years, and it's not because we're not lending any money.
Right.
We do require crazy things now, whether it be FHA or conventional, like you need to be employed. I know we're pretty strict like that.
Yeah.
So if people think that's difficult, then yes it is, but banks are
You need to be
absolutely
paying your
lending
bills.
money. Yeah, you have to pay your bills, you have to have income. You know, it's not just you have to have a heartbeat and you want to buy this house. It's not like that anymore for obvious reasons. Everyone knows
Right.
that, you know, we have to be a lot stricter, and mortgage fraud is up. So we just have to dot our I's and cross our T's, and there's, you know, there used to be this much paperwork and now there's about this much paperwork, but we're getting it done. And first time home buyers or 27th time home buyers, we're definitely getting financing, whether it's FHA, conventional, VA, or USDA.
Right. Marcy brings up a good point, and I've had probably done 5-10 videos about this in the past, is if you're applying for a loan, you're about to apply for a loan, you're looking for a house, don't quit your job. Don't take a new position at your company without talking to your lender first.
Don't turn self-employed.
Yeah, don't go self-employed. Don't go buy a new car or a refrigerator. I've had clients go out and buy all of their new furniture before they close on the property.
Yes.
And that drops their credit score,
Absolutely.
and they can no longer qualify. Actually, one lady quit her job before we closed, like 3 days before we closed, and they called to verify employment a couple days before. So that's really important. Pay all your bills, pay all your credit card bills, keep that credit score up, and make sure nothing changes to keep the underwriters happy.
Absolutely. Don't do anything until those keys are in your hands, because we will verify, and then we'll verify it again. Whether it's us doing the financing or another lender, it will be verified all throughout the process, absolutely. And the smallest thing that you might think isn't a big deal might absolutely be a big deal. Don't dispute any accounts either. That's another one that people don't think of. If they're fighting with their credit card, just leave it alone for now. Pay it. Dispute it when you're done with the transaction, because that can really muck up the works too.
Got it.
Yeah.
Very good. Well, thank you again.